Hello everyone, welcome to Global Online. This is Dr. Swati is here. So today's session is for those students who are preparing for June 2025 UGCNET specification, especially for the commerce and management subjects. So today we are going to continue our Maha marathon session of day 2. So here we will discuss all the 10 units complete revision of your from your subject. Okay, so can you hear me? Just give me confirmation. Okay, voice is okay. Let's start. We have too many questions to do. So let's start with the session of today here. So student, first question which is in your screen, that you have to try to solve it with yourself. Then I'm always with you to answer you and to explain you the things. Okay, so first question which is in your screen and which is asked in this question, that is assertion is given to you. The assertion is about the proposed dividend is shown on the liability side of the balance sheet. The reason behind is given that the proposed dividend cannot be distributed unless it is approved in the annual general meeting. So first of all, student, you have to know what is the meaning of the proposed dividend. So proposed dividend is the dividend amount which is recommended by the company by the company to its shareholder, but for the approval. Okay, but this proposed dividend is proposed by the company, but it's depend on the shareholder, either they accept that proposal of dividend or either they reject. So this is your proposed dividend. Okay, so the first statement, that is proposed dividend is shown on the liability side of balance sheet. Yes, it is true, because this is a dividend, this is a liability for the company. But until and unless shareholder will not accept this proposed dividend, you cannot write this proposed dividend on the current liability, in the section of the current liability, because until and unless the shareholder not get acceptance. Okay, so this dividend is considered as in the out of the box of the current liability, but you have to write this proposed dividend, on the liability side of balance sheet. So this is true, but if they specifically mention over here you have to write in the current side of liability, in that condition it will be wrong. Okay, so you have to answer, you have to evaluate the question like this. Okay, so hi Samiksha. Okay, if you have any query you can ask me. Okay, and try to answer the question. Okay, now the reason is given behind. So yes, assertion is true. Okay, but the reason is given that proposed dividend cannot be distributed unless and until it's approved in the annual general meeting. So yes, both the statements are true, that is proposed dividend cannot be distributed unless and until this is the annual general meeting is annual general meeting it is accepted in the annual general meeting, it is decided in the annual general meeting. Okay, so yes, both the statement are true over here. So both the statement are true and they correctly explain in the annual general meeting. Okay, correctly explain the reason. Okay, now so here is the explanation is also giving to you. look look over here. Now I just quickly tell you about the global online. Here you will get complete course of commerce and management. Okay, our new batch will be started from the 21st of March, from the tomorrow, and you will get daily live lectures over here, recorded session in case you are not you are unable to see any reason, if there is any reason. Okay, so you know that you will get what you will get over here. You will get over here the complete syllabus notes in PDF format. 100% syllabus we are covering over here. Along with that we are also taking a revision, but this revision is we are taking on the basis of whatever the PYQs or from the last previous year, from the last 15 years previous year. Okay, then we analyze this previous year question paper and we make most expected MCQs MCQs question, and we will taking both. We are taking revision with the help of PYQs and MCQs over here. You will get full syllabus mock test here, 4000 MCQs with detailed explanation. Then PYQs you will get detailed explanation. If you register yourself for the paper 2, either for commerce or management, you will get paper 1 free of cost. So contact number is given in your screen. You can get in touch with this WhatsApp contact number. Okay, now how the exactly how do you install and how do you see our recorded and demo session. So for the registration or seeing the recorded session or demo session, so here you have to download the global online app and you have to register with your mobile number, and then you have to whatever the course do you want, you have to register your search on the my course section, and then you have to register. Once you register, you can see the unit wise folder is given to you for the paper 1 plus paper 2. And the recorded video session is available, daily live session is available. Okay, so in this way you can get a very crisp and a very systematic manner of the notes. Okay, and you can prepare yourself for the June attempt very well. Okay, so let's start with the second question, that is two statement is given to you. The first statement is that statement number 1. This is continuation of a business entity as a going concern is a pursued as a basis for financial reporting unless and until the entity's liquidation become imminent. Second statement is given, cash basis consider the revenue are realized when the goods are purchased. Okay, so the both statements are given to you and they are not connected with each other. Both statements are different from each other. You have to evaluate which statement is true and which statement is false. Okay, so here you can see do state that continuation of business entity. First of all, what do you mean by the business entity? Business entity principle, you know that this is the accounting principle. Okay, and this business entity concept say that business is separate from the owner. That means business is a different entity, and the owner who run the business, the person who run the business, the owner are two different entity. Okay, and going concern say that is assume that the business will be continue operating indefinitely, not be liquidated, and its asset are value based on the ability to generate a future income. So that is your going concern. So statement is continuation of a business entity as a going concern is presumed as a basis for the financial reporting unless and until the entity liquidation become imminent. So isn't it true? Are you think that is this statement is true? Yes, the first statement is true because in the business entity concept and going concern is a continuation presume that basis of the financial reporting. Okay, unless you are not going to be liquidate this. Okay, the next statement is about that is a cash basis consideration. Cash basis consider the revenue are realized when the goods are produced. When we produce our goods, then we realized our cash. So isn't it then we at that condition we realize a revenue? Isn't it true? So this is a false statement. Okay, so according to this option, the statement number 1 is true, and but statement number 2 is false because the cash basis accounting recognize the revenue only when cash is received, not when the goods are produced. Okay, production of goods, producing of goods is a different thing. Most of the time whatever we are produce is not sell out, or we not get a cash from that production. Okay, so producing a goods is a different thing, and receiving cash is a different thing when we are sell out that goods and services. Okay, so this is the next one. Assertion and reason is giving to you. Now here you can see assertion for a large business concern, an auditor instead of checking detail of all the financial transaction has to take up test checking based on some statistical sample techniques. Reason is given behind of that when the volume of work involved in working is large, and a detailed verification of all the financial transactions can be produced by adopting the test and checking on the basis of statistical sample techniques. Okay, so student, here you can see when the business is concerned with the large data, when the transaction is the financial transaction of that business is having a very large, in a very huge amount. So in that condition, you calculating one by one transaction and taking the entry of one by one, so it will going to be difficult to calculate in this way. So in that time, when we have a large data to see the financial position, financial transactions, so auditor, in that condition, auditor use statistical sample techniques, because it is easier to calculate the data, large data. So yes, this is assertion is true. And what is the reason? When the volume of work involve the large, so yes, when the volume of work is large, so they adopt to check their value, and they adopt to check the financial transaction with the help of statistical sampling techniques. So this is exactly the both assertion and reason are correct, and they correctly explain the assertion. Okay, so here they clearly explain that assertion, that test checking is used specifically because of large volume of transaction. When we use statistical analysis test, when we have a large sample generally. Okay, non-random sampling, non-parametric test especially. Okay, now next question, assertion reasons question, that is, first assertion is giving to you, ratio analysis is one of the tool employed to know the financial health of concern. So yes, ratio analysis, why we calculate, why we study the ratio analysis, because ratio analysis help us. This is a financial statement tools that assess the financial health and performance of business. Actually, it's help to the shareholder, or not only the shareholder, to all the stakeholders. And so the stakeholders, this helps to the stakeholder to calculate or to know the liquidity of company, to know the profitability of the company, to know the solvency and efficiency of the company. So the ratio analysis helps to the stakeholder to know how the financially healthy a particular company. Okay, so yes, this statement is true. Then the ratio analysis is not the only technique available to take a investment decision. So yes, ratio on the basis of ratio analysis, this is not only technique with the help of we decide a investment decision, because there are so many techniques is available, like your cash flow analysis. Okay, like your trend analysis, what trends is in the market, so trend analysis help them. Then the comparative financial statement, when we make a comparison between the statements, so the comparative financial statements help to calculate or to evaluate the financial health of a company. Okay, so these are, so reason is not true, but the assertion is true. Okay, so here the right answer will be, what will be the right answer? Both other statements are true, but both other statements are true, but they are not exactly explained the assertion. Okay, so ratio analysis is not only, yes, this is true, not only, yes, not only this, not only, there are many techniques, so it is a true. If we said only techniques, then it was false. Okay, so this is true, but the reason is not exactly explain the assertion. Yes, now the next question. Next question, that is assertion. Again, I have taken many questions belongs with the assertion and reason, because many of time we are get confused in this kind of question. So max to max we solve this kind of question, so it will help us to making practice of this question, so it will be help us. Okay, so next question, the financial statement prepared on historical cost basis result in erosion of capital in long run. Isn't it true? Then reason is given behind of that. The management, the maintaining the book of account as per current purchasing power technique only may contain the inflationary pressures. Okay, so assertion and reason. So assertion is given, the financial statement is that the financial statement prepare the historical cost basis do not actually do not account of inflation. Yes, because it's not a account of inflation. Over the time, this result is an the understanding of asset value and lead to capital erosion. So as the real value of money decreases. Okay, so this all has happened in when the financial statement on the basis of prepare on the basis of historical cost. Because of historical cost, it's not historical cost do not give the exact amount of inflation. What is the inflation rate? Okay, so the over the time the value of the asset is going to be undervalued. Okay, so asset value is under, because we have consider the historical value of the asset. So that's why it's result erosion of capital in the long run. So yes, this statement is true. Now the second is given to you, that is maintaining book of account as per the account purchasing power technique only may contain the inflationary pressure. So in the current purchasing power technique, accounting adjusts for inflation and help maintain the real value of capital. This current purchasing power technique ultimately help to calculate or to evaluate the real value of capital. Real value of capital. Okay, and it's this is not only method. Okay, so over the technique is current accounting, that is CCA, that is current cost accounting, is also used to calculate the inflationary pressure. Okay, so assertion is true and reason is also true, but it's not fully explained to the assertion. Okay, so yeah, that's why the option number 1 B is correct over here. Okay, yes. The next question, that is a situation in which number of competing firm is relatively small is known as, where in which firm the competitions are relatively small as compared to other firms. So option is given: oligopoly, perfect competition, monopoly, or monopoly. So what if, in the perfect competition there are many firms. Okay, if there are many firms, that means there are a large competition. Okay, that means there will be no market control. That means anyone can get entry in the market and anyone can get exit from the market. So this is a perfect competition. What about monopoly? So monopoly is the one that dominate the buyer. Yes, that one that dominate to buyers. Okay, that is your monopoly. And what is a monopoly? So in the monopoly there is only one seller in the market, and that seller dominate in the market. Okay, he having a dominant position in the market. So what the question? A situation in which the number of competition firm is relatively small. So in the oligopoly, the number of competitors is small because there are few sellers in the market. Okay, but this firm has significantly control over the price. You have to keep in mind that control over the price and often engage in the strategy decision making. Okay, so yes, the option number 1 will be the correct answer, oligopoly. Yes. Now next question, match the pair question. This is match the pair question. So here list 1 and list 2 is given to you. First, economic of scale, economic, internal, external economic, internal economics. This is wrongly typed. Economic, external economic, internal economics, then economic of scope. Okay, so what is the economic of scale? Economic of scale you have to match with. So first of all, economic of scale, the meaning means lowering cost of production by producing in a bulk. That means this is matched with your second, mean lowering cost of production by producing in a bulk. That is your economic of scale. Okay, and economic of scale, this you have to keep in mind. You know that economic of scale is occur when increase in the production, when your production process is increases. So when your production is increases, okay, in that condition it's lead to the lower average cost. Yes, because you're increasing your unit of production, so it just helps to lower the average cost due to the factors like a bulk purchase, bulk specialization, increase the efficiency and improvement. So that's why this is the economic of scale, means lowering the cost of production by producing in a bulk. Okay, now what is the internal economics? So internal economics arises when the cost per unit depend on the size of firm. Yes, so internal economic is based on your arises. This internal economics arises when the cost per unit depend on the size of firm, because internal economics are cost saving, having the advantage of cost saving. Yes, it's having the advantage of cost saving. That's with the help of that, individual firm experience is to expand the financial transaction, to improve the managerial decision, to improve the technical things. So this will help. So this is arises when the cost per unit depend on the size of the firm. Yes, then the economic external, you can say external economics arises when the cost per unit depend on the size of industry, not the firm. Okay, so you know that the difference, internal, that means this is a firm, so internally this one, and externally. Okay, so here you can see external economic benefits all the firm in an industry due to some factors. These factors like your better infrastructure facilities, better supply chain, better networking. Okay, and you have a skill pool of managers, skill laborers, okay, employees. So this is the external economic. Okay, now the economic of scale, you have to match with this one. Now economic of scope. So economic of scope arises when the lower average cost of manufacturing a product when two complementary products are produced by single firm. Okay, so economic of scope occur when the firm produce multiple product, when firm produce or industry produce multiple product in the market. Yes, and which is efficiently used in as a share resources. So this will helps to reduce the cost. Yes, so this is your economic of scope. So yes, you have match first with the second one, so these options is going to be cancelled. Then the second one B with your third one, so yes, option number C will be the right answer. Understood? Now the next, this one, the option number C is right. Yes, this explanation is given to, I will provide you this PPT, this PDF after the end of the session, okay, in the group. Okay, yes. Look, the next question, that is statement number 1 is given. Point price elasticity of demand in terms of marginal revenue MR and average revenue can be measured with the following formula. So if you know what is the formula of the marginal revenue and average revenue, you can easily get this. So this question, this is belongs to the question of this question belongs to the economic. Okay, So the point price elasticity of demand, in the point price elasticity of demand can be expressed by using average revenue and marginal revenue here. So which formula? ED, elasticity of demand with the help of average revenue divided with your average revenue minus marginal revenue. So this formula derived from the relationship between what? Your marginal revenue and with your with that is elasticity or in the your imperfect competition scenario. Yes. So in the second statement, so first statement is true. Yes, in the price elasticity of demand, there here we see the relationship. We calculate, we measure the MR's relation with your average revenue. Okay. What is MR? Marginal revenue. That means what additional you are getting from if you add 1. Okay, so that is your marginal revenue. Then the statement number 2, the point price elasticity of demand is the product of the slope of demand function and the ratio between the corresponding price and the quantity. So here you can see in the price elasticity of demand, the product of slope of demand function. Okay, so for the slope of demand function, the ratio of price to quantity. So here what formula? ED, here I can write the ED, elasticity of demand, the demand of quantity divided with the price, multiply with price divided by change in quantity, change in price. This is change. Okay, this is a change in quantity divided with change in price, multiply with price divided by quantity. So this is a standard mathematical formula for the point elasticity of demand. So yes, for the point elasticity of demand, in the product of the slope of demand function, the ratio corresponding to the price, here we consider the price and here we also consider the quantity. Yes, so this formula with the help of price and with the help of quantity, whatever the changes we have seen over the period of time in the price and the quantity, you have to multiply these changes with the real price and the real quantity. So yes, both the statements are correct. Yes, in the point elasticity of demand, we make a comparison between the marginal revenue and the average revenue, and in the point elasticity of demand, the product of slope, if you want to calculate the slope of the demand function, in that for that way, because the demand function is made with the price and the quantity demanded. So with the help of price and the quantity demanded, we calculate our point elasticity of demand. So yes, the both statements are true over here. Yes, so both statements are correct. Here is an explanation. Now I will give you this PDF, don't worry, in a group. Okay, in our WhatsApp group. Yes. Now the next one. Next question is assertion. Again assertion and reason, but I know this is going to be a very harder or very boring when I'm taking every question of assertion and reason, but trust me, assertion and reason, this kind of question they ask next in a June attempt. I know, I'm sure that they ask this kind of question. They make a maximum question pattern in this way, assertion and reason, on the basis of assertion and reason. Okay, so just we are doing a practice. Okay, now here the assertions is given, the profit is a reward for innovation. Isn't it true? And the next statement is given to you, that is the interest is reward for the postponing consumption. So what is it true? Yes, the first statement is true. The profit is a reward for the innovation, because actually this particular statement is given by the person, that is Schlemchter. Okay, he gave this statement in his theory of innovation. Okay, and the profit is reward of entrepreneurs innovation. He give his theory in the theory of entrepreneurs innovation. So entrepreneurs introduce new product in the market. Okay, and gradually he improve his production process. then it create a new market which give us a positive effect to the product, okay, and lead to temporary monopoly profit. Because if anything newly introduced in the market, it create a profit. New innovation always create a profit, but this new innovation is always create profit. When I said always, always is applicable only when this innovation is actually beneficial for the society, beneficial for the person, okay, in that condition. Now the reason is given, interest is reward for the responding postponing the consumption. Here you can see this statement and these statements are both statements are not matched with each other. So we know that first thing we are sure that R is not a correct explanation of aim. But now the second statement, R is, isn't it R is correct or not? So let's check. Interest is a reward for postponing consumption. So yes, this is true, because according to the time preference theory of interest, okay, this one is given in the time preference theory of interest. Individual prefer present consumption over the future consumption. They want a consumption in a present day, not in a future day. So the interest is compensation for delaying your consumption, okay. So this is allowing the fund to invest or loan out. So this is the interest is reward for postponing the consumption. Yes, because you are carrying that consumption for a long period of time. Yes, so this is yes. So reason is not correct, but both statements are correct. So here option number 1, no, option number 2, because is not correct. No, yes, they are not correctly explained to each other. So option number B is correct, that assertion is true, reason is true, but reason not exactly or explain or correctly explain the assertion. Yes. Now the next question, that is the statement is giving to you, the other 3 statement is giving to you. You have to evaluate which statement is true, which statement is false, okay. First statement, at a point of sati means maximum satisfaction, okay. Satis means where you will get maximum satisfaction, okay. So at the point of sati for a commodity, D, marginal utility is negative. Oh, isn't it true? Marginal at a point of satisfaction, here you can see I'm drawing a diagram. You can easily match with this, okay. This is your total utility and this is your marginal utility, okay. The point where your marginal utility is at the point of 0, your total utility in the point of his is in his maximum level. That means when your marginal utility is 0, in that condition your total utility in his maximum point. That means a customer or consumer in that particular point get a maximum satisfaction. Yes. So this statement is saying at a point of sati, that means maximum sati, this point, in this point you draw this like this, okay. So in this point he say marginal utility is negative. Never. In this point, when the consumer in his maximum level of satisfaction, marginal utility will not be negative, it is 0. Yes. So this statement is false one. That means statement number 1 is false, okay. Now the statement number 2, a rectangular hyperbolic shaped demand curve on all its points has unequal slope and equal point elasticity. In a rectangular hyperbole, what do you think? What will be the right answer for this question? You have to mark. Let's see over here. Here you can see A rectangular hyperbole demand curve on all point has an unequal slope and equal point elasticity. So yes, this statement is true because it rectangular hyperbole represent the unitary elasticity of demand. Unitary elasticity of demand, that means if you increase your price by 10, so it decrease your quantity also by 10. If you decrease your quantity by 10, it increase your quantity by 10. So that is your unitary elasticity of demand, that is a rectangular hyperbole. So in the rectangular hyperbolic curve, points has unequal slope but equal point elasticity. So yes, this is true. The slope of curve vary but elasticity remain constant. Here you can see your slope of curve is flexible, but your point elasticity, this one is static, this one is remain constant. This will not going to be changes. So this is a true statement. Okay. Price skimming, next statement. Price skimming is a strategy by which a firm change the lowest initial price and then increase it over time. So isn't it true? In the skimming, the strategy by firm is changing lowest initial price. In price skimming, company said, or the strategy is used in skimming. They charge highest price in initial period, then gradually reduce its price. So this is also false statement. So here statement number 1 is false and third one, C1 is false. Only B is true. So option number 1 will be the correct answer. Clear? Yes. Next question is match the pair. It's also again from the economic, again this question from the economics. Okay, so look over here, that is perfect elasticity. Where I drawing the perfect elasticity, that means this one. Your price elasticity is equals to infinite. Okay, that is your perfect elasticity. So you can match, this is not why this is infinite. Okay, so you have to match the perfect elastic with the fifth one. So option number, either it's option number C or either it's option number D. So we can easily cut option number B and C. You can use elimination method, okay, in this kind of question when you solve this kind of question. Then perfectly elastic. So perfectly elastic when your price elasticity is equals to 0. Yes, is equals to 0. That means your quantity demanded is static, that means is remain constant, but your price is going to be changes. Okay, so this is your perfectly inelastic, so it's equals to 0. Then unitary elastic, you can easily match unitary elastic with the 1. Unitary is equal elasticity where your elasticity is equals to 1. That means if you increase your price by 10, your quantities also increases by 10. If you decrease your price by 10, so quantities also decrease by 10. So that means your E is equals to 1. That is unitary elasticity. Then elastic that means there is a more movability. That means if you smallly change, if you take a little bit of change in your price, it's largely affect, is majorly affect to the quantity. Yeah, I can draw this. If I change, this is my actual price and quantity. Okay, if I change a small, if I take a small changes in price, okay, if I increase the price, if I okay, this is a if I increase a small price, my quantity demand is going to be down in a large amount. If I decrease a small price, is my quantity demanded is increased with a huge amount. So this when we draw this like this, so this is your elasticity. You can see the changes of huge difference in a price and a quantity. Okay, that is your elasticity is greater than 1. Okay, there is a small changes in price, there is you can see a big change in the quantity demanded. Okay, and inelasticity, that means if your, that means nothing, that means you can see there is an elasticity is less than 1. That means if you increase your price, I increase by here little bit, increase in quantity, decrease in quantity. If you decrease your price a little bit, little bit decrease in quantity. So there is, if there is a small changes, you can see a very rare changes in the quantity demanded. So that is your inelasticity of demand. Okay. So this is, you can match with elasticity is less than 1. So what will be the right answer? Fifth. A is fifth, B is fourth, is same. Okay, and D, and the property of second, that is elasticity is greater than 1. Okay, so yes, option number C will be the correct answer for this question. Okay, you may solve in this way. Here is explanation is also given to you. Okay, now the select the correct answer. When goods is used for multiple purpose, then demand for these goods is called as direct demand, multiple demand, composite demand, joint demand. So what do you think, what will be the right answer? What is asked? First of all, what he is asked in the question, when a goods is used for multiple purpose. Okay, this suppose one kind of goods, if we use that particular is for the multiple purpose, like milk we use milk for making the curds, you can say dahi. Okay, curd, then buttermilk for getting ghee. Okay, so these are, if the goods is used for the multiple purpose, then the demand for goods is called as direct demand, multiple demand, or composite demand, or joint demand. So this kind of, if we use a goods, a particular goods in a many things. Okay, so here this is your composite demand. Composite demand is refers to the situation where single goods are demanded for multiple purpose. Like by with the use of milk, we can make a cheese, we can make a butter, we can make a yogurt, we can make we can either directly consume the milk. Okay, so this is, so here right answer will be composite demand. Okay. Next, cost incurred because of new decision taken by management. Okay, because in the firm, management take a new decision. So because the management take a new decision, new cost is arises. So what is that cost? What is that cost? Isn't it sunk cost? Isn't it variable cost? Isn't it fixed cost? Isn't it incremental cost? Okay, because your management take a new decision, that means which is added, the additional, you can say this is the additional decision. Okay, so this if this is the additional decision, that means it is the additional cost. Okay, isn't it? This is the additional cost, that means it is nothing but your incremental cost which is incurred due to new decision taken by the management. Like if management want to launch a new product in the market, to expand the production capacity, to enter into the new market with a new product, so this kind of decision if taken by the management, so the cost is incurred by them, it is called as incremental cost. Yes, now the variable cost and fixed cost, these are the daily levels cost that we include. Okay, variable cost, we have to, whatever the daily expenses we have, daily overhead expenses we have calculate, and fixed expense fixed cost like your rent. Okay, whatever the rent, go down rate you are paying, light bill you are paying, so these are the fixed costs which you are paying fixed amount of money in a monthly basis, or in the quarterly basis, or yearly basis. Okay, so this is this one sunk cost, that the cost which is going to be backdated. Okay, Yes. Now the question is, in long run equilibrium, the price in perfectly competitive market is equals to option number 1, short run marginal cost, short run average total cost, C, marginal revenue, and D, none of the above. So what do you think, what will the right answer for this question? In the long run equilibrium, price is perfectly competitive in the markets equals to, okay. So when you see this question, so here in the long run perfect competition, in the long run equilibrium occur when the firm are the earning zero economic profit, and this profit economic profit, and this profit is nothing but your normal profit. Yes. So here you can see, whatever the price is decided, this price it will be equals to your marginal revenue. What is the marginal revenue you will get? So such firm is kind of your, for the long run equilibrium, such firm is kind of your price taker. Who is price taker? Like your perfect competition, okay. So they are price taker. So that's why when you are a price taker in the market, so this is the exact happen in the perfect competition. Marginal revenue, that is your price, is equals to your marginal revenue, okay, in a long run. But when we are talking about for the in the short run, what happened in the short run in the SATC, okay. So short run average total cost in this point, okay. In this point, while the price may equals to elasticity and SMC, small marginal cost, is equilibrium, and this is not a defined condition in the long run. So the firm optimizes based on the long term cost rather than its short term fluctuation. Yes. So that's why what will be the reason for, if we are talking about the long run equilibrium, in case of perfect competition market, it's your price equals to your marginal revenue. It's equals to your marginal revenue. So right answer will be marginal revenue will be the right answer, okay. Why this happen? Because they, in the long run, in the perfect competition, they are the price taker, not a price maker, okay. So they are price taker, that's why your additional revenue is called your price is equals to your marginal revenue. Yes. Now the second statement, the next question is statement number 1. On every point on this straight line demand curve, the point elasticity are equal. The point elasticity are equal. Second statement is giving to you, on every point on the rectangular hyperbolic shaped demand curve, the point elasticity are not equal. So what do you think, what will the right answer is? It's actually in your screen, that is option number B. Both are incorrect. Why both are incorrect? Because on every point on the straight line demand curve, okay, if I'm drawing the straight line demand curve, this one straight line demand curve, point elasticity are all equal? No, because the linear demand curve price elasticity of demand is vary at a different point, because here the price elasticity is different, here the price elasticity is different, here is the price elasticity is different, okay. The elasticity is high at the upper portion, okay, because here you can see the elasticity is greater than 1, but when we are comes lower and down, so the elasticity is less than 1, and here this point, here you can see the elasticity is equals to 1. Here you can see the elasticity is infinite, and here you can see the elasticity is equals to 0. So this is in case of every point of time, in the straight line demand curve, the point elasticity are not equal. Okay, there in the upper portion you can see there the high price elasticity. In the midpoint you can see there is a unitary elasticity, and at low you can see the inelasticity. That means elasticity is less than 1. Yes, the next statement, that means this statement is false. Yes, on every point on the rectangular hyperbolic shaped demand curve, point elasticities are not equal. Actually, both statements are just opposite to each other. In the straight line, point elasticities are not equal, but in rectangular hyperbole, the point elasticity is equal. Okay, so here you can see a rectangular hyperbole demand curve, the price elasticity is a constant. That means in rectangular hyperbole is nothing but your unitary elasticity. Yes, unitary elasticity, which I have explained in the last question. Yes, this is rectangular hyperbole is nothing but unitary elasticity. So in this unitary elasticity, if you draw any point in the demand curve, that is equals to the point elasticity is equal in every point of the demand curve. Okay, so yes, both statements are incorrect. Okay, now let's move toward the next question. Special drawing right. This question is belongs to special drawing rights. So what is not true regards to the special drawing rights? Statement number 1, that is special drawing rights are supplementary foreign exchange reserve asset and maintained by International Monetary Fund. Yes, and SDR are the unit of account for the international IMF, and SDR are claimed to currency held by IMF members country for which they may be exchanged, and the SDR are currency of IMF. What do you say? This is not true. That means this statement is, which statement is false? Which statement is false? So yes, option number D is false, because SDR is not a currency. It's not a currency of IMF. Yes, SDR is a supplementary foreign exchange reserve asset that is maintained by the International Monetary Fund, which is controlled by the International Monetary Fund. That is SDR. SDR is a unit of account of IMF, International Monetary Fund. This is also true. SDR are claimed to the currency held by IMF member country for which they can exchange, but SDR is not a currency of IMF. Yes, yes. Next question, the assertion is giving to you and reason is giving to you. So assertion is return on investment is a prime ratio for judging profitability of company. Then reason is given, the turnover of company play a major role in determining the return on investment of the company. So let's understand the first assertion. Return on investment is a prime ratio for judging the profitability of the company. So when we're talking about the profitability ratio, so this profitability ratio is used to evaluate how efficiently a company generate profit related to its investment. Yes, and it helps to assess the financial performance of the company and make the assertion on the basis of that. So yes, the ROI, it helps, it's given idea to the judgment of the profitability of the company. So yes, first statement, that is assertion, is true. Yes, now the reason is given, the turnover of the company play a major role in determining the return on investment of the company. So yes, because its impact on the ROI. If the turnover is highly, class sales can contribute to the better profitability, but turnover alone does not directly determine the ROI, because what cost efficiency a particular company use, what capital structure is particular company use, what a profit margin he every year company earn, so that's on the basis of that you can judge the profitability, the ROI on the basis of that, but only with the help of turnover, this is not true. Yes, you can judge on the basis of your cost efficiency, you can judge on the basis of capital structure held by the company, on the basis of whatever the profit margin, which the profit margin play a crucial role for determining the ROI, return on investment. So here statement number 1, both other statements are near about correct, but it's not, are not exactly explain the assertion. Yes, so here the option number B is correct. Yes, look, now the next question, which of the following analysis is suitable for risk return analysis in financial decision? So when we talk about the risk return analysis, we can easily get a click of that. This is the analysis which use under the CAPM, or either in a SWOT, either in a duo point analysis, or either in a EVA analysis. So here you can easily mark your question right answer with the risk return analysis. We discuss their financial decision in our CAPM model, because in the CAPM model, the formula of the CAPM model, that is ER is equals to your return, that is your RF. Yes, RF, return risk free return plus beta, you have to minus RM with RF, that is your risk premium. Okay, and you have to multiply with, yes, this is a formula. Yes, this is a CAPM formula. So in this CAPM formula, we analyze the risks and return, which on the basis of which we can take a financial decision. So here you can see this beta is nothing but your systematic risks. There are the two risks. Okay, the systematic risks, this is risks which are uncontrollable, and unsystematic risks, that is which you can control. Okay, and this is RF is nothing but your risk free rate, okay, this is your risk free rate. And RM, that is your market return. From that market return we reduce risk free premium rate, we will get market premium price. So yes, this is your CAPM analysis. So yes, option is right answer will be CAPM. Yes, now the next question, that is your match the pair question. Here you can see that is Modi Gilani Miller approach. Okay, so now we are going to be very quickly, because these are the simple question. In the Modi Gilani approach, we say the arbitrage approach, because explain the arbitrage process and arbitrate how, that means to give the give exact overview of what arbitraging, that means taking lowest risk. Okay, that means selling goods or services from high market and purchase from the lower market, that is your arbitraging. Then net operating income approach. So net operating income approach we have seen in capital structure. Yes, and the short term money market instrument we have seen in the commercial paper, and the factoring is a part of your working capital. So you can easily mark this one. Now what is the factoring? So factoring, I will explain you. Factoring, it is involves selling account receivable to the third party for immediate cash, if they help of cash, immediate cash, so helping business managing working capital efficiently. So this is your factoring. So you have to match factoring D with your second one. So D with your second one, this one. Then B net operating income approach you can match with easily, that is capital structure. So option number A will be the right answer. Yes, yes. So next question, that is capital budgeting. You can easily match the capital budgeting, profitability index, capital budgeting, profitability index, internal rate of return, then your capital investment decisions, capital budgeting, it's matched with you can easily match the capital budgeting with the planning capital structure. Okay, then profitability index is matched with profit, benefit and cost. Okay, A match with fourth one, B match with the third one. Okay, then internal rate of return, you can match internal rate of return with the time adjusted rate of return. Okay, so you have to match with this one. So C will be the right answer. Capital investment decision, it's nothing but your irreversible. Okay, so capital investment decision which often involve large and long term commitment, that's why this is irreversible. So it is costly to reverse, that's why capital investment decision is irreversible. Okay, yes. Now the next question, this is the last one question, after that we can end this question. Okay, so financial break even point. Financial break even point is a point at which the minimum level of earning before interest and tax needed to satisfy the fixed financial charges. This is your what? Financial break even point. So this is a point level where earning before interest and tax, that is your EBIT, at which the company cover the fixed financial cost, like your company's interest, company's preferential dividend. Okay, so this one, so this is your financial match with fourth one, that is A is matched with fourth one, this one, this one. So two options going to be cancelled. Now the cost volume profit analysis. So in the cost volume profit analysis, this is the analysis where we study the relationship between, in CVP model, what we study the relationship of the fixed cost with their variable cost, with their sales volume, with their profit. This is what we study in the cost profit analysis. So this is, you can easily match with third one. Okay, so here option number 1 will be the correct. Then internal rate of return. So this is the rate of discount at which your NPV is 0. IIR, the point at which your NPV is equals to 0. Okay, when your NPV is reached to the point of 0, then this is your internal rate of return. Then non-operating income approach, this is your cost of capital remains same for the different degree of financial leverage. Okay, so if you use your debt ratio or equity ratio, so at a particular point of time, or your cost of capital remains same for the different degree of financial leverage. So you can match with this your second one. So yes, option number 1 will be the right answer. Okay students, so now we are ending today's session over here. If you like my session, so please like it, and please do subscribe, and if you want more question like this, so it will be helpful for you, so you can comment me in a comment box and type more. Okay, we want more. Thank you so much.